Hi there, Shingirai here again with another update on portfolio performance over the past week. On a one-week basis, all 10 of the CBAM portfolios outperformed their respective benchmarks with returns ranging from 0.18% for CBAM portfolio number 1 up to 1.5% for CBAM portfolio number 5 V2 on a relatively risk-on week. Investors took bets on the ever-evolving or artificial intelligence theme and also trying to look for some natural sort of sectors that will be winners, and that's reflected in the performance of our global thematic position through LNG. Our clean energy position also up more than 2.8% on a very risk-on one-week basis, and we also saw a recovery there for our Bailey Gifford European equity position alongside Allianz Continental European, also up more than 2.6% on the week. In terms of detractors from performance, we did see headwinds for interest rate sensitive assets such as our Hypnosis Songs Trust alongside sterling corporate bonds, both down more than 0.5% on a one-week basis. And also we continue to see those headwinds from really deterioration in economic data coming out of China, and that's reflected in the performance of Columbia Threadneedle China, down 0.51% on the one-week basis. On a quarter-to-date basis, 2 out of 10 of the CBAM portfolios outperformed their respective benchmarks with returns ranging from minus 1.38% for CBAM 1 V2 up to 1.4% for CBAM portfolio number 5, and that was really reflecting the full three months up to 30th of June, where we've still seen that runaway performance in US equities initially, really coming out of that period where we had some strains coming from the financials and banking sector, and just recently all the banks major banks having recently passed their Fed stress test, and which is seen as a positive towards the end of the quarter. But also there was that large concentration element in the rally we've seen for the US markets, as we've been highlighting over the past couple of months, and that will be to companies that will be in any way at an advantage in this artificial intelligence race to the top. That would see S&P 500, our hedged position, up 8.29% versus our unhedged position up 6.99% in US equities there. And then we also saw that strong performance from Pictet Global Clean Energy, again up 5.15%, as we really investigate the case, which is attractive for those clean energy enabling technologies such as semiconductors, which were sharply derated in the previous year, really coming back on as a favorite trade as well. In terms of the China story, we continue to see headwinds there, with all 3 of our positions down more than 12% on a quarter-to-date basis. And we did see, despite seeing some improvement in manufacturing PMI data earlier this week coming out of China, ultimately I think investors are widely just looking for that sort of structure or indication of any sort of possible fiscal stimulus coming out of Beijing, whilst they also walk the tightrope of avoiding injecting inflation into their domestic economy as well, and a possible implosion in the property sector. So a bit of a balancing act there for Beijing, and that's been reflected and priced in, I'd feel at this point, based on the performance of our Chinese equity positions across various time periods. In terms of manufacturing PMI, I did mention earlier that Chinese PMI manufacturing improved. We got improving UK data as well. US manufacturing PMI moving sideways, but Europe also contracting. In terms of services PMI, that's been going down across all sort of reporting areas, China, Europe and UK. But what's been more interesting as a data point coming into this week really is highlighting that resilience in the US jobs market. And we did see today non-farm employment data, which really measures the changes month on month in private employment in terms of the US market, coming in as a figure of 497 new jobs being added, despite we did see also an increase in initial jobless claims, but really that figure triggering a broader sell-off in the market as it sort of sets up the United States Fed for further tightening and just to ease that inflationary pressure in the economy.